Women plus real estate. Real estate insight for decisive, intelligent women who learn, rent, own, invest, and live with intention. Here's what's happening this week. All right, so it's Saturday, February 28th, 2026, and if you're just glancing at the headlines while grabbing your coffee, it might look like business as usual in the real estate world. Yeah, just standard noise. Right, the usual ups and downs. But if you actually pay attention to the data, like really dig into the raw numbers we have on the desk, this isn't just a normal weekend. No, it's really not. In fact, I would argue we're looking at a moment where two massive signals have flashed at the exact same time. And they're pointing in a direction that honestly, most people are completely missing. That is a pretty bold claim because from where I'm sitting, the market looks confused. Sales are down, but prices are holding. Rents are up, but vacancies are up. Feels messy. It feels messy because we're at an inflection point, right? We have a stack of reports here, market intelligence, rent data, investment volumes, and they are all pointing to this specific date. First off, signal number one, mortgage rates have officially dropped below 6%, which is huge, but I mean, we've been flirting with 6% for a while. Yeah, did we actually break it definitively? Yeah, we smashed it, like 5.98% to be precise. Yeah, the first time we've seen a number starting with a 5 in 3.5 years. That is a massive psychological barrier removed. Wow, right. Okay, so that's the good news. But then there is signal number two, and this is the one that frankly sounds a little sci-fi to me. We aren't just looking at government data anymore, we're looking at a prediction market. People are actually betting real currency on where US home values are going to land. And that market resolves tomorrow, March 1st. Right, and the smart money, the people putting millions on the line, they've already made their call. Yeah, they have, and we're going to get to that prediction because it is wild. But first, here's the plan. We need to reconcile these contradictions for you, listening. We're going to look at the rental market, the home buying chaos, or lack thereof, and where the big institutional money is flowing. Does it, and correct me if I'm wrong here, the data looks a little contradictory right now. It does look contradictory on the surface. You have affordability going up, but sales going down. You have rents ticking up seasonally, with landlords getting nervous. But if you connect this to the bigger picture, the theme isn't confusion. The theme is a closing window. A closing window? Exactly. There's a specific narrowing window right now for everyone involved, renters, buyers, and investors. But it won't stay open forever. Okay, I love a good window of opportunity, but I need you to prove it. Let's start with the rental market. I was reading the apartment list report for February 2026, and my first thought was, well, break is over. For the fourth year in a row, February marked a return to rent growth. Right, it's the standard seasonal shift. The data shows rents increased month over month in 49 of the 54 largest metros. So I'm a landlord, I'm popping champagne, right? Winter is over, rents are going up, I'm back in the driver's seat. See, that is the trap. If you just look at that one month-over-month stat, yes, it looks like a rebound.
Yeah.
But you have to look at the leverage. Despite that seasonal bump, the actual leverage sits firmly with the tenant. You cannot let the seasonal noise drown out the structural reality. Hold on, structural reality sounds ominous. What does that actually mean?
Rents are going up, but tenants have the power. How does that math work?
Look at the absolute numbers. The national median rent is sitting at $1,357. That's down $20 compared to exactly this time last year, February 2025. And if you zoom out to the peak in mid-2022, rents are actually down $85 a month. That's a significant chunk of change over a year. I mean, that's $1,000 a year back in a renter's pocket. It is. But here's the metric that really matters if you're trying to gauge the temperature of the market, the National Vacancy Index. It's at 7.4%. Is that hot? It's a record high since 2017. We are nearing a decade high in empty apartments.
Wow, so nearly 8% of apartments are just sitting empty right now?
Exactly. And for a landlord, an empty unit is the most expensive thing in the world. It's a massive liability. There's a metric called list to lease time, okay? Basically, how long does it take from putting up for rent sign up to actually getting a signature? Right now, it's 40 days. Wow, 40 days. That's double the wait time landlords were dealing with back in mid-2021. 40 days. Okay, let me play devil's advocate here. If I'm a landlord, 40 days is annoying, sure, but it's not bankruptcy. Why does that give me, the tenant, leverage? Because cash flow is oxygen. Think about it. If a unit sits empty for 40 days, that is more than a month of lost revenue. That's a permanent loss. Yeah, you never get that February rent back. Yeah, landlords are sweating. They are waiting twice as long to get cash flow. They are desperate to stop the bleeding. Which begs the question, why? If the economy's decent, why are there so many empty units? Did everyone just move back in with their parents? It's the hangover. We are still dealing with the massive construction boom of 2023 and 2024. Just in 2024 alone, over 600,000 new multifamily units were delivered. That's huge. That's the most since 1986. That is a lot of supply to absorb. Precisely. It takes time for those units to fill up. And it's not just apartments. The single-family rental market is seeing it too. Rent growth there slowed to just 1.2%. And in the hotspots, places like Florida, Texas, Arizona, we're actually seeing rent declines. Okay, so let's turn this into action for the listener. If you're listening to this and maybe your lease is up in a month or two, what does this mean for you? Do you wait for prices to drop further? No, do not wait. The next 60 to 90 days are absolutely critical. We're in this weird transition period where the seasonal data says prices are going up, but the supply data says landlords are desperate. So negotiate it. What should be on the list? Like, can you just ask for lower rent? I feel like most people think the price on the website is the price. Yeah, aggressively. It absolutely is not the price. In 34 of the largest metros, rents are down year over year. You have data on your side to ask for a rate below the asking price. But don't stop there. Ask for the first month free. Ask them to waive the application fee or the pet fee. I feel like people are afraid to ask for that stuff. It feels kind of cheap. It's not cheap, it's business. Remember that 40-day stat? Your landlord knows that if you walk away, that unit might sit empty for another month and a half. That vacancy costs them way more than giving you a free parking spot or knocking $50 off the monthly rate. They want to close the deal. But you said the window is closing. By summer, that seasonal momentum usually takes over. Landlords regain their confidence, the moving season hits full swing, and those concessions dry up. If you are renewing or moving, do it before April. Got it. Okay, let's pivot to the home buying market because this feels like a total paradox. It is the most confusing data point in the market right now.
Right, so buying has become more affordable for 9 months straight, rates are dropping, and yet sales are falling. January 2026 sales dropped 8.4%. If it's getting cheaper to buy, why is nobody buying?
Let's break down the affordability first because numbers are actually quite staggering. The National Association of Realtors has an affordability index. It hit 116.5 in January. That is the best reading since March 2022.
Okay, so on paper, people have the money.
Yes, and here is the statistic that really blew my mind. When mortgage rates dropped from where they were to 5.98%, do you know what happens to the buyer pool?
It gets bigger, obviously.
It explodes. An additional 5.5 million new households now qualify for a mortgage today that did not qualify a year ago.
Wait, pause. 5.5 million new households. That is the population of a small European country, or almost 2 Chicagos, just suddenly getting a yes from the bank.
Correct. Exactly. They crossed the debt-to-income threshold just because of that rate drop.
That is a massive amount of kinetic energy sitting there. So where are they? Why did sales drop 8%? If 5.5 million people just got a golden ticket, why aren't they cashing it in?
Psychology. It's the psychology of waiting. When you see rates dropping, your natural instinct isn't to jump, it's to wait and see if they drop more. People are sitting on the sidelines waiting for perfect conditions. They want the rate to be 5% again, or they want home prices to crash. Which sounds risky because if 5.5 million people are waiting and they all decide to jump in at once, that is the danger. That's the slingshot effect. We estimate that only about 10% of those newly qualifying households might enter the market soon, at still 550,000 new buyers. If they wake up and start making offers, competition spikes instantly. The perfect condition they're waiting for actually destroys the advantage they have right now. Precisely. The perfect time usually looks like high competition and bidding wars. The imperfect time right now, when sales are down and headlines are boring, is when you can actually negotiate. Let's talk real numbers, because affordability can feel a bit abstract. Break down the dollars and cents for us. Does 5.98 really make that big of a difference compared to 6.7? It makes a massive difference. Let's take the median home price, which is roughly $396,800. A year ago, at 6.7%, your principal and interest payment would have been $2,314 a month. Okay, $2,314. Today, at 5.98%, that same house costs you $2,126 a month. So that's, doing quick math, roughly a $188 a month in savings. Nearly $200 a month back in your pocket. That's real money. Over a year, that's over $2,200. But the crucial part isn't just the $200. It's that you're saving that money while competing against fewer buyers because everyone else is still waiting.
So you're saying I get the discount and I don't have to fight 5 other people for the house. Are we seeing any markets waking up to this, or is the whole country just asleep at the wheel?
Exactly. There are pockets of activity. St. Louis is up 8% in pending sales. Virginia Beach is up 7.6%. So the smart buyers in those areas are moving, but nationally, the herd is still waiting. Which brings us back to your theme of the window. If you're a buyer, you have affordability and low competition. That seems like a rare mix. It is exceptionally rare. Usually when affordability improves, buyers flood the market and prices go up. Right now, there's a lag. That lag is your opportunity. Okay, let's switch gears to the big money, the institutional investors, because while regular families are sitting around waiting for the perfect interest rate, it seems like the smart capital is already making moves. That's the difference between emotion and math. Institutional investors, the pension funds, the private equity firms, they aren't waiting. They moved in 2025.
What kind of volume are we talking out here?
Apartment investment volume hit $165.5 billion in 2025. That is up 9.4% from the year before. And keep in mind, 2024 was already a recovery year. This is sustained acceleration.
And what are they buying? Just anything?
They are very specific. They are focusing on multifamily apartments, and the cap rates, which is basically the return on investment, are averaging 5.7%. That is the tightest cap rate of all properties.
Okay, you dropped a jargon bomb there. Tightest cap rate? Translate that for us non-finance folks. Why is a low number good?
Think of it like a government bond or a very safe savings account. When an asset is considered risky, investors demand a high return, maybe 8 or 10%, to justify buying it. When they're willing to accept a lower return, like 5.7%, it means they see that asset as incredibly stable and safe.
So, because they're accepting a lower immediate payout, it means they're confident the value is there long term.
Exactly. It's a vote of confidence. They're saying, we believe in the fundamentals of renting so much, we are willing to pay a premium for it.
Now, we have to touch on the political landscape here because there has been some noise coming out of Washington that affects investors. And just to be clear for the listeners, we're looking at this strictly from a data perspective, impartially.
It raises an important question about policy risk, regardless of politics.
So, on January 20th, President Trump signed an executive order targeting large institutional investors, specifically those owning 100 or more single-family homes, stopping them from receiving federal support. Right, and then almost immediately, Senate Democrats introduced a competing proposal. So lots of headlines flying around, Wall Street kicked out of housing and things like that. But if I'm an investor listening to this, should I be panicking? We need to look at the nuance. The executive order specifically targets single-family rentals, houses. It does not affect the multifamily sector, the big apartment complexes. Yeah. Okay, so the big money is mostly safe from the specific order. Right. Because they're in apartments, not houses. Okay. Exactly. And even within single family, the context is important. There's this narrative that Wall Street owns every house on the block, but large institutions only own about 3 to 5% of single-family rentals nationally.
Yeah, that seems shockingly low given all the noise. I feel like I read articles saying they own entire neighborhoods.
Well, in some specific markets, they do. In Atlanta, they own 28%. In Charlotte, 20%. Houston, 9%. So if you live in Atlanta, it feels like they own everything. But nationally, it's a small slice. So this policy is really about ring-fencing single-family homes for owner-occupants. Correct. The message from Washington, from both sides actually, is that single-family homes should be for families to buy, not for corporations to rent. But multifamily, that remains wide open for institutional capital. So what is the takeaway for an individual investor? Say you're listening and looking to buy a duplex or a small rental property. First, don't try to be a hero on appreciation. The days of buying a property and watching it double in value in 3 years are paused. Focus on cash flow.
Monthly income over future value.
Yes, and underwrite conservatively. Model 1 to 2% rent growth. Do not model 5%. And most importantly, ignore the national headlines about vacancy. We said national vacancy is 7.4%, right? That is totally irrelevant to you. Why is it irrelevant? Because you aren't buying the national market. You are buying a specific street in a specific neighborhood. Your local submarket might have 2% vacancy, or it might have 12%. Real estate is hyper-local. Don't let a national statistic scare you away from a good local deal.
Okay, now here is where it gets really interesting. We have talked about the past, what rents did last month,
What sales did in January. But there's something new happening that is looking at the future. The prediction markets. This is honestly the most fascinating development in data analysis I've seen in a decade. This is signal number 2 we teased at the top. This isn't a survey where you ask a guy, hey, what do you think homes will be worth, right? No, surveys are flawed. People lie or they guess. This is Polymarket and Parker Labs running a betting market. Explain the bet. The question is, what will the median home value in the US be on March 1st, 2026, which is tomorrow? And people are betting real money on this. Millions of dollars in volume. And that is why it matters. Surveys are cheap, opinions are free, but when you have to put your own cash on the line, you do your homework. These markets aggregate thousands of informed traders who pay a financial cost for being wrong. It acts like a truth serum for the market. So what's the bet? What does the smart money say is going to happen tomorrow? Traders have assigned a 97% probability that home values will land between $420,000 and $425,000. That is extremely specific and incredibly confident. 97%. It's very high confidence. And if we look at the current reality, the Parker Labs index right now, it shows the value at $420,720. Bang in the middle of the range. But why should you, as a listener, care about a betting market? Is it just for fun, or is there a real utility here? Exactly. It's about the speed of intelligence. Think about how we usually get data. We look at the Case-Shiller Index or CPI reports. That data is 2 months ago. By the time the government tells you home prices dropped and it happened 8 weeks ago? Right, it's like driving a car using only the rearview mirror. Exactly. If these prediction markets resolve correctly tomorrow, and it looks like they will, we have a new tool. We have headlights. We have a way to forecast home values a month in advance with high accuracy. That changes the game for planning. If I know what April 1st looks like on March 1st, I can negotiate differently. That is the power of it. It moves us from reactive to proactive. If the prediction market says prices are crashing next month, you don't buy today. If it says they're spiking, you lock in your rate now. So let's bring this all home. What does this all mean? We've covered a lot of ground today. If you had to synthesize this for the listener, whether they're renting, buying, or investing, what is the headline for them? The headline is, the market isn't waiting for perfection, and neither should you. Let's break that down by group. Renters. Renters, you have leverage, but it's leaking away. Negotiate now. Don't wait for the spring flowers to bloom in April or May. Lock in those concessions while the 7.4% vacancy rate figure is still scaring your landlord. Buyers. Buyers, you have the holy grail mix right now. Affordability is up because rates are down, but competition is low because sentiment is bad. That combination does not last. Once the sentiment catches up to the rates, once those 5.5 million people wake up, you will be in a bidding war. And investors. Investors follow the big money into multifamily fundamentals, but keep an eye on the single-family legislation and stop betting on appreciation.
Cash flow is king. And honestly, keep an eye on those prediction markets. It feels like we are seeing a shift in how we understand data.
It raises a really provocative thought for everyone listening. We're so used to judging our decisions based on what happened last month. All prices went up in January. But we are entering an era where market intelligence is about what traders are betting will happen tomorrow. So if the prediction markets are right about March 1st,
Yeah.
if they nail this number, how does that change how you plan for April? If you could see the future price of real estate with 97% accuracy, would you still be sitting on the sidelines? That is a question worth chewing on. And hey, remember, everything is negotiable, whether it's your rent, your closing costs, or your lease terms. Don't be afraid to ask. The worst they can say is no, but right now the data says they are highly likely to say yes. We will definitely be watching that prediction market resolution tomorrow. Thanks for listening in. Always a pleasure. That's this week from Women Plus Real Estate. Full newsletter with data, links, and archives at womenplusre.substack.com. Until next week, keep your eyes on the market.